So let's talk about the Venture Capital 2022. Great panel. We have a fantastic panelist here. I have to turn over to the screen, make sure that everybody's here. So we have Purvi Gandhi, managing partner of Quain Investment. And then we have Phil Hirsch, founder of and managing partner of Cervus Group and the Tech Coast Angels. Then we have Gene Massey, chairman and CEO of MediaShares. And then we have David Liu, founder and CEO of Liucrative endeavors. So I'm not going to take too much time about talking about myself because that's not the subject, but as Marty said, I've been here for 35 years, starting as a software engineer and kind of worked my way down and up in a different ladder of things. And then I feel like I have a little bit of knowledge of what's going on, but hopefully the panelists will enlighten us with their view on what's coming in 2022 as far as the venture capital is concerned. So, so the way that I would like our great panelists to work is to talk about themselves for a couple of minutes and then doing the introduction. And I'm going to ask everybody in the order in which the actual program was written to talk about who they are and what they represent. So let me start first with Purvi. Are you there? Is Purvi there? I know she had some issue.
Let me just see if I can
connecting up.
Just keep on going.
All right. So let's go to.
I'm going to turn her into a speaker.
Okay, there we go. Fantastic.
So she's in.
Hey, Purvi, can you hear us?
Hi, how are you?
Oh, great. Thanks for being patient because we were delayed by 15 minutes, and I know that you were trying to log in. So, Purvi, can you tell us a little bit about yourself and what the Quain investment is all about?
Can you see me? Can you hear me?
Yeah.
Yes.
Okay, great. Hi, my name is Purvi Gandhi, and Quain is a firm that we started last year. The idea behind Quain is that there has been a significant disruption in venture investing. So while we hear about disruption across sectors, there's been equally a disruption in who accesses the earliest stage of a tech company and who gets to invest. And that change had become increasingly prolific over the last 6 years. I ended up building a model with the overseas Chinese group to invest at scale, 200 million across 300 plus early and growth stage tech companies, and ended up delivering 25 unicorns and almost 10 IPOs and SPACs within 6 years. So that led to the formation of Quain, which is the first institutional firm that will invest in a high volume of early and growth tech companies. And we can do that primarily by partnering with a distributed network of GPs who are solo capitalists, individual tech operators writing checks, and whose deals we continue to triangulate.
Well, thank you so much. Next in the line is Phil Hirsch. Are you there?
I have to chase down Phil. I have to chase down Phil and
Okay.
and Dave.
Okay. So Gene, are you there?
Yes, I'm here.
Hey, Gene, how's it going? So
Fine.
Yeah, good seeing you.
Same here.
So tell us a little bit about yourself.
MediaShares is a consulting firm that walks companies through the crowdfunding process on platforms like Start Engine, Seed Invest, WeFunder, Republic. We help them first with their corporate governance to make sure everything's up to snuff. We help them introduce them to the right platform that fits their type of offering. And we help them in every manner with their marketing, because you should really replace the word crowdfunding with marketing, because that's really what it is. You're marketing your offering on a platform. So we basically take a company all the way through the whole process. And then our last two companies, when they finish with their crowdfunding offerings, we introduce them to companies that acquired them So we have a kind of a complete process that we go through when the company needs, early stage company needs capital.
Great. Great. So let's get this ball rolling, and let me ask first, Puri, the question for you. As the new investors are entering to compete for the new unicorns, how do you see your access to those companies? How do you find those new fantastic startups that have a good potential of becoming a unicorns?
Yeah, it's a great question. Touching a little bit upon what I said earlier, that there's just been a massive fragmentation of access to tech venture deals. Growing up in the industry, I would see maybe the top 50 venture firms consistently getting all the deal flow. Starting maybe 8 years ago, you saw a rise in sort of smaller funds that came into the scene. Starting 6 years ago, you then began to see a very interesting new set of investors who are the tech entrepreneurs, the millionaires and the billionaires coming out of the IPO, who have sector expertise in their areas of expertise, whether it's fintech, whether it's biotech, whether it's enterprise SaaS, consumer. And they would be sought after by the next generation entrepreneurs to support their earliest development in the company. So they would end up being angel investors. And as their deals progress to the next stage, that's when we enter, right? We enter at that stage where the company's progressed, has a roadmap to revenue. Now, doing this investing, one of the things I learned is even some of these early advisors and investors stay very engaged with the company, even as it continues to grow. So sometimes they would bring us access at the growth stage of a company, not just early stage. And this is the new ecosystem that I began to work with 6 years ago. And that's the ecosystem that we work with at Quain.
Okay, great. And then how do you like find them physically? Is it do you organize events to get them, or are those referrals, or how's that process?
So in some ways, I credit some of the work that we did over the 6 years working with the overseas investors capital, right? We deployed 200 million across 300 early and growth stage tech companies, as I mentioned. And to do that, they had struck a partnership with a platform called AngelList. And AngelList is one of the many platforms now where such operators, tech operators actually go and syndicate out their access. But you're seeing thousands of deals. And so the question is, who are the good ones, right? Which are the good deals? And that's where the work is. The work is not in access. The work is in determining who are the top tech operators that you want to align yourself with, who are the top microfunds, who are the top solo capitalists. And I basically found them building the strategy over the last 6 years. So at Quain, which has now become the first institutional firm to create a venture as a product, right? Venture product versus traditional venture fund. I basically ended up partnering first with Jayant Kadambi. He was a tech entrepreneur himself. He had taken his company public. Jayant is my business partner. He himself is an investor in a high volume of tech deals and microfunds. And Jayant and I kind of created our database of who we know are the top operators, and then going to them and starting to get deal flow from them. In the last year, we've gained access to 3,000 deals from this vetted network, not just broadly, but just the vetted network. And we've already invested in 32 companies across stages and sectors.
Well, thank you very much. I guess that David Liu is connected up with us. Are you there, David?
Yeah, I'm here.
Okay, great. Can you tell us, introduce yourself to us, please?
Yeah, sure. So I was an investment banker for about 25 years. I built the Internet and Technology Group at Jefferies & Company. And I financed a lot of Web 1.0, Web 2.0 companies, sold them, took them public. So did that for kind of the first half of my career. Then I retired and I became an entrepreneur. And I started four companies, one of which is probably the most relevant for this conversation, is a merchant banking firm where I make investments and I am actively involved in the companies that I invest in. I do very few deals in the 8 or 9 years that I've had my firm. I've done about a dozen deals. So I really focus on a very small number. And I try to focus on things that I know well. So I focus primarily on internet, software, and consumer. Those are kind of the 3 areas that I have a lot of experience and relationships in. And my model is not really scalable. What I try to do is I try to invest and buy equity in these companies, and then really become the right-hand person to the founder CEO. So I'm a big fan of movies, and I'm a big fan of the movie The Godfather, and I liken myself to the consigliere or the Tom Hagen for many of these founders. So I'm the person they call, when they're trying to figure out how to raise capital, divest a business, acquire a company, go public, do some type of financing, as well as I also started a technology company myself as an entrepreneur, and I sold that business, and the business had about 1,000 employees. So I've gone through kind of the whole life cycle of PowerPoint to running a multinational company. So in the last couple of years, a lot of my counsel to companies I invest in is heavily focused on the operations side. So everything from HR to sales, marketing, product development, things of that nature. So yeah, that's a little bit about me and the areas that I invest and focus on.
Great. Well, that sounds fantastic. Hopefully you don't have to drown anybody in the Lake Tahoe, as a part of your deal making. And talking about killing things, let's talk about to Gene, because Gene has another idea on how to deal with venture capital. He says that the crowdfunding and crowdsourcing is the way of making things happen. So Gene, tell us more about what the crowdsourcing in your view.
Sure, let me correct that, because if you have a friend who's a venture capitalist and they offer you a great deal and you feel wonderful about the valuation that they offer you, and they'll give you all the money that you need, then I would suggest you do that, because crowdfunding is a lot of trouble. Not only that, but with a good venture capitalist, you're going to get a lot of help that you will not get from the crowd necessarily. But the advantage of crowdfunding is that you can get funding when you can't get it from venture capitalists very often. And you'll get it at a much better valuation, because most of the people in the crowd don't know what the word valuation means, quite honestly. They go on a platform and they look at your offering and they go, wow, that looks cool. They're going to make a lot of money with that. And they'll put in $250, $500. And before you know it, you've got some seed capital, usually a few $100,000. I think the average raise is $500,000, but the really good ones can get up to 5 million under Reg CF, which is regulation crowdfunding, allows you to raise up to 5 million. And so it's an advantage. You can get it at a better valuation, and you can get it when you're pre-revenue, don't have a dime, and you don't have a product yet even. There's a very famous offering that was on Start Engine, and it was a solar company that had a new way to make solar cells faster, cheaper, and would produce more electricity. And they got $5 million on a $200 million valuation. Now, I told that to my venture capitalist friend, and he said, get out of here. don't come back. Because you won't find that from a venture capitalist. But the bad news is they spent the 5 million developing the product, and now they're raising another $2 million. So, it's not always the smartest thing to do to invest in these things, but there are possibilities for getting money when you can't get it from a venture capitalist, and you can get it when you're pre-revenue and even when you're pre-product. So that would be why I would recommend it mostly.
Mm-hmm. Well, I understand that, Gene, but essentially you're creating yourself like the the startup itself has, they're shooting themselves in the foot in essence that once they create this crowdsourcing money and then have a multi-hundred, let's say, investors, their cap table is sort of screwed up. And then
Let me address that. That's a very good point, because right away, no venture capitalist wants to take on a company that's got 5,000 investors. And so what most of the platforms do now is they have an SPV and they roll all of their crowdfunded investors into one investor, and they have a lead investor who oversees everything and responds to the crowd, so to speak. So you only have one investor in most of these deals.
Oh, that's good. Although I would still say that, if you can get your deal with the VC and then hopefully not being eaten by VC.
Agreed.
Deal,
100% agreement.
The deal is probably smarter because those guys are going to have money, but not a lot of help as far as the, like the development of the project moving forward. But that's a great stuff. And then I think that a lot of those platforms are starting to mature, as you said, like the Republic and whatever the number of other ones that are coming up. And allowing those unfundable being funded, right? So
not only that, but it's actually, crowdfunding is on fire now because of everybody being at home a lot. And in the past few months, they've done as much as they've done in the last year, and even the last couple of years. If you look at the chart, they've just really gone crazy, and everybody's caught on to it. But the bad news is I'm not seeing the exits. A lot of these companies are getting money and they don't really have a clear exit path. And that's a huge problem. Whereas a venture capitalist would help guide you toward an exit or an acquisition or something. But most of these crowdfunding deals that I've seen, we did get our last two companies acquired with a lot of trouble, but it's very difficult most of the time. They get a few $100,000 and they make their product and then they go, well, yeah, what's next? And some of them go on to a Regulation A offering, which is a mini IPO that allows you to raise up to 75 million. That's the best thing that's happened in the SEC in about 50 years. And a lot of the companies that go on to a Reg A and a listing, they do have an exit. But many of these companies that are doing little Reg CF offerings don't really have a plan, a good solid plan for what the exit is going to be.
But maybe that's the opportunity for you, Gene, to actually provide them with the proper advisory board and so on, and taking them to the next step. But talking about making things a little bit smaller, the question for Purvi. Purvi, I see that some of your expertise is also to see more microfunds. Which happens to be like a new category of investors continuing to grow across the world. Can you tell us what those trends are all about, and then how one can participate in them?
Yeah, absolutely. I think the strength of a microfund is traditionally it's a small pool of capital, 25 million, 30 million. It's run by a solo GP. Who is basically hustling to get into the top deals for her or his fund. And they can be very nimble, so they can be very fast in writing the first check. It is more often than not in an area that they're already familiar with and they've built their career in from kind of the tech operating side of the house. And we partner with them as their companies kind of mature to the next phase. And somebody talked about taking capital from venture capitalists who can be great value add. And I second that. I don't know that all of us venture capitalists are value add, but that is a very important signal that I pick up, because I'm never co-leading or leading around in a company as I used to in my prior firms. Our model is to participate in the highest quality deals through access that these microfunds and solo capitalists are bringing us. In terms of where to find them, I think, Arthur, that you just have to stay very, very tuned in to all the developments and the news. Look, I would have loved to be in San Francisco in person today. I had plans to be all the way until this morning. And those are exactly all the places that you meet some of these smart people. They are not going to be out there marketing their funds per se. They don't have fundraising agents. They're raising from a lot of high net worths and getting going with their first fund. Many of them don't even have ambitions to be raising large funds and going through SEC registration. They just love to raise 10 million at a time and deploy, be the first check in, 20 great ideas, right? And then we pick maybe one or two of the great ideas at the next round as these ideas are maturing.
Sounds great. Let me just roll over to David. David, you were talking about making about 12 deals over the time of your fund. Can you tell us a little bit about it? And I mean, historically things have changed, right? Because even the seed right now from YC is about 500K. I know that this is just going towards like a bigger numbers, but what it is that you perceive in the near future and in terms of like your investment. So let's say if you will have another investment this year, what's your sweet spot? Like how much money do you invest in? And also I'm curious to understand more about your interest. I saw your little films on ABC, like a joke films, really funny little stories. Can you tell us a little bit more about it? I think that this is very interesting and entertaining and educational as well.
Yeah, so kind of zooming out a little bit, I don't have outside investors, so all the capital I deploy is my own capital, and I approach this really like a family office with a barbell approach where I have the vast majority of my assets in highly liquid securities, not necessarily heroic returns, but certainly, I try to optimize that. I was a Wall Street guy for 25 years. My wife was a hedge fund and venture capitalist for 25 years. So between the two of us, we know quite a bit about investing and how to value things. So on one end, we do a lot of investing kind of in highly liquid, low risk categories. And then kind of taking the barbell analogy, there's a pool of capital that we deploy in private situations that are highly illiquid, that are highly risky, and you just never know if you're ever going to see any return there. And that's where I focus my merchant banking activities. And I'm very careful about the companies and things that I focus on. I'm a huge believer in focusing on things where I have an unfair advantage. I'm not a subscriber to the idea of being a professional angel investor and just being one of a dozen to 24 people on a cap table. That's just not for me. For some people it is, but it's just not for me. So where I think I have an unfair advantage are areas where I have a lot of transaction history and I have a lot of relationships. So internet is a really obvious one because I've been covering the internet space for 30 years, almost as long as the internet's been around. So I've seen a lot, I know a lot of people, and there's a lot of people I can call on, if I'm trying to do due diligence. And then I try to primarily focus my investment on people that I know really well. So if I look at the dozen or so deals I've done, I think only one of them was someone that I knew for less than a year. Almost everybody else I'd known from anywhere from 5 to 10 years. And in a lot of situations, I was that person's banker in their first company. So we went through some, exciting, maybe, challenging times together where I was working for them. And then now that I'm an investor, they're kind of working for me. So it's a really great situation where how people have dealt with adversity, and they also respect you, right? Because they don't look at you as just like someone with a checkbook. They look at me as someone that, yeah, I'm investing, but also, I added value to them in other ways in the past. So that's kind of how I kind of focus. I'm not really specifically sector focused per se, but it is areas where I have some experience. The only area that I've invested in where I didn't know anything, but I'm personally quite interested is entertainment. So that was an area that I didn't know a whole lot about. I covered digital media. I had, partners like, I was at Jefferies for a long time. So I had a partner like, the infamous Steve Bannon was my partner on the media side. So he covered media, I covered digital media. So I didn't know much about the media space. But when I left banking, I wanted to learn a lot more about that. So I got involved with, Greg Silverman, who used to run Warner Brothers. So I backed him, making films and TV down in LA. I backed Vivek Tiwari, who is one of the top producers on Broadway and arguably the #1 Asian American producer. And so through them, I've learned a lot about the film, TV, and Broadway business, the entertainment business. But that's definitely an exception. Almost everything else I do is internet, software, AI, hard deep tech, areas that I've done a lot of work in. And I don't frankly disclose the amount that I invest because it doesn't matter. I'm not raising funds and whatnot, but it'll range anywhere from a couple $100,000 to a couple $1 million. So it's meaningful dollars for me. And the stage of companies is all across the board. I've been really fortunate. 5 of the companies have hit $1 billion or more in valuation. Some of them have done really phenomenally well, like Figs, which is a medical apparel company, internet brands WebMD, which we sold to KKR, and I'm still involved there. So there's just been some that have been great. And I would say that most of the time I kind of get involved at the, traditional kind of Series A, Series B stage. I really don't do pure seed. And I usually kind of get involved when the company is, maybe starting to iterate around product market fit of that nature. And then the last thing, you mentioned my cartoon thing. So I was an artist when I was really young, and I have Asian American parents, and they said, like, there's no way you're going to be an artist, So now that I'm much older, I can kind of do whatever I want. So, I wrote a book with cartoons in it and career advice. It's really for young people and for people that feel underrepresented. So I wrote the book for minorities, women, people of color, and all the proceeds from that book go to charity. I do that cartoon strip that you saw, the ABC Life, because I saw that there's no cartoon strips about Asian American families. So I said, well, why don't I do one? And that's syndicated on Asia Am News. I do a little bit of freelance painting. This painting's mine behind you. So I just try to, exercise some of those creative muscles that, my Asian heritage killed when I was younger, but now I have the opportunity to explore.
Omni-talented. But tell me, so if I'm a startup now, I have to rendezvous you for at least 1 year. But now with the situation where most of the meetings are kind of the Zoom meetings, right? So how does one gets into your network?
I'm not really looking for deals. Probably my career, I've done, 150, 200 transactions. I have, worked with 5,000 companies. So I don't have any shortage of a network on the entrepreneur side. It's really a question of what's interesting to me and what is the intersection of what that company needs. So I have a lot of people that, I maintain contact with and I'm helping, but, the stars aren't aligning where, I'm not interested in investing. They don't really want me on their board, right? And that's totally fine, right? So I'm not soliciting and looking for new deals. In fact, my focus now is much more on, continuing my entrepreneurial journey and starting companies in areas that I find personally interesting, where I'm going to be the CEO or the chairman. And so I would say that that's definitely taking on more of my focus in 2022.
Sounds good. Well, thanks for the stories. That's really fantastic. Appreciate it greatly. Let me switch over to Gene for a little second. Gene, here's the question. So we have we're supposed to be talking a little bit about what's coming, what we're defining as 2022 year, what's going to be changed in this whole situation as far as the raising the capital. We know that there's plenty of money like right now that a lot of pre-seed money are, the term sheets are written on napkins, and the $20 million checks are being floating around here, there in New York and Miami. San Francisco is starting to get vacant a little bit, but the deals are still happening. So what do you see as a trend right now in terms of the deal making and then the VC in general, with all of the different platforms and the money supplies? How do you foresee that year? Is it going to be different than last year, or it's just like progressively a bit different?
It's constantly going to change. You're seeing all sorts of strange things happening that you're questioning. Where is the SEC, and why is this legal? For example, NFTs. One of the problem with this, one of the questions in the what's the test, the Harold test? What is
The Howey test.
The Howey test, if it's a security, is, are you expecting a return, or are you expecting your thing to increase? And everybody's buying NFTs expecting them to increase. So isn't that a security? Well, then how are they doing that without registering them or something? So there's a lot of things that are in a state of flux in the SEC as far as regulations. So I think you're going to see a lot of new regulations, although they are slow. You would not believe what it took to get the Jobs Act passed. That was something that Patrick McHenry started when he saw some guys that decided they were going to buy Pabst Blue Ribbon, and they got $200 million on the internet. And they realized, wait a minute, you can get funding on the internet. They were eventually had a securities violation because they didn't know you had to, they didn't know all the rules. So what you're going to see now, I think, is a lot of new rules. Start Engine's got a thing where they're financing collectibles like wine storage and stuff like that. And I've got a 1970 Cadillac convertible, and I was thinking maybe I can get NFTs for it or something. You start thinking about all these new things that are coming, and what it's going to be. It's like, it really is the wild, wild west now. Crowdfunding is on fire. Everybody's, if they've got an idea, I've seen people get, a couple of $100,000 for an idea that wasn't even a good idea. And so there's a lot of money floating around. There's a lot of crowdfunding. I think the venture capitalists are not crazy. They're not going to go in like David is not going to do something that's pre-seed even, he's going to wait till, let me have a product and let me see you sell it before you come up with some money. So it's just the Wild West right now. And it's all in a state of flux due to the SEC taking so long to figure out what the rules are going to be on certain things. That's my prediction.
Actually, Marty has a question.
Yeah, Gene, can you hear me?
Yes.
Yeah, so this gets back to crowdfunding. And so
Sure.
I mean, we have traditional venture capital. What a lot of people don't understand is that, venture capitalists, and again, Dave would be a great expert on this. Venture capitalists have a fund document, and on that fund document, they're contractually obligated to stay within parameters of investing, right? It's not like Dave Liu can say, look, I'm a family office, I can invest as I like, right? But VCs typically are have a highly stringent, structured approach, and a lot of people go to them who may be crowdfunded or not, but it's always been said that many VCs frown upon crowdfunded companies because they just won't invest in them, although some are now looking at crowdfunding. I think Andreessen Horowitz has invested in a few, et cetera. So there's this pathway of getting crowdfunded, but you're not going to get any VC funding. But a lot of people are like saying, well, you know what, we can do crowdfunding, get some gap financing, and then once we get to a certain level of revenue, like not necessarily become a unicorn, but be like a pre-unicorn. We can go public in Australia, get bought out. Actually, there's a company, and the name of it is Global Public Offering Fund, and they kind of specialize in this. They'll invest in like VC-backed or crowd-funded companies with the plan to take them public in 18 to 24 months, right? Or to have them sold. Like they have a pretty good purview of different industries. They're experts in taking companies public in Australia and Canada, which are highly liquid, marketplaces. I think even in they're taking them public in the UK. So can you talk a little bit about that? Because there's a decision tree, right? And the decision tree is, I'm getting crowdfunded. Maybe I do a Reg A. Maybe I do this going public. Can you talk about that and what that world looks like?
Sure. First of all, crowdfunding, I started in '98 and I called it fan financing. And I was going to finance NASCAR teams and movies and all sorts of things. I even have an issued US patent for financing movies on the internet. It's expired now. That's how long ago it was. But Purvi is crowdfunded. She got her, and correct me if I'm wrong, but she got some of her limited partners. She's got a group of people that came in to invest. Most venture capital firms are crowdfunded. They've even advertised for limited partners now. So it really shouldn't be a bad word. It just means a group of people that are investing. Now, that said, the crowdfunding on the platforms, you have a lot of investors. You'll have hundreds of investors. I think they had the company that I spoke of earlier that got $5 million. They had 4,000 investors that invested, I think, $1,200 and something a piece on the average. So yes, there is a thing with having a lot of investors, and yes, venture capitalists might not like that. But the thing I do want to address is the regulations under crowdfunding. It is not a picnic to walk you through the crowdfunding process. You have to have all of your financials audited. Well, they actually call it a CPA review if you're only going to get $1 million. But if you want $5 million, you have to have an audit. And if you want to go do a Reg A, you have to have a PCAOB audit. So the rules there are very strict, and you can't advertise certain things. Whatever you say, off the platform, you can't make a deal with anybody off the platform. You can only drive them to the offering on the platform. That platform has a legal department that reviews everything that you say. For example, in one of our offerings, we wanted to say, you'll be buying pre-IPO shares because we have a Reg A plan. Well, they wouldn't let you do that. They said, well, you might not have a Reg A. So it's very strict. It's not a picnic to do the crowdfunding offering. Not only that, but it's very expensive. You will spend, on the average, 10% of the money that you get to market it. You'll get about, on the average, anywhere from $5 to $20 for every dollar you spend in marketing. So if you spend 10% of $1 million, you spend $100,000 in marketing to get the million. That's tough. Not only that, but there's another 6.5% to 9.5% for the platform charges. So wait a minute, I've got to spend almost 20% to get the money? Why on earth would I ever want to do that? 2 reasons. Number one, venture capitalists won't finance you. And number 2, you got a better valuation. And number 3, there's another reason. The money that you spend for marketing to get the investment also markets the company. So you get 2 for 1 on that 10% dollar spend.
Gene, just to cut in, I mean, it's very rare to get VC financing, right? I mean,
it is.
Right, it's the creme de la creme who get it. And a lot of times you have to have a certain sort of background. So, I think somebody did a study recently and they said 25% of VCs went to like Stanford, Harvard, and Wharton. And like 40% of the companies get funded have somebody from an Ivy League school or like, a tech comparable like MIT or Caltech, in their company. Right. So if you're not in that league, then it's I think it's very difficult. Maybe you have, a better measure of how difficult it is.
Well, no, I think you're right. If you want a top VC firm to finance you, you better have some serious people on your team. Even those guys that got the $5 million on a platform that I was telling you about, they had all these MIT scientists on their team. So you looked at it and looked like a great team. But back to your thing with venture capitalists, yes, they want really top people on your team. The crowdfunding is exactly the opposite. Let's pretend I'm a motorcycle mechanic and I create a new motorcycle that's a little bit different, I can put that on a platform and I can get it financed. I don't need a degree. I don't need anything, because most of the people see that, they go, wow, that looks cool. Electric motorcycle, that's really going to go. And so that's how you get funded there. They don't care if you went to school. All they say, you can say you're a motorcycle mechanic or you were a motorcycle racer or something, and you show pictures of yourself racing the motorcycle, and that's how they get funded. It's dumb money most of the time.
I might even say that it's as hard to get funding from family offices like Dave and Lou as it is to get funding from a VC, right? Because Dave's got his own, gravitas and his own, satellites that circle him that provide his deal flow. And if you're not connected to one of those guys, then you're not going to.
David's not going to read your offering. So you're not going to get far enough for him to read it. Am I right, Dave? I can email you an offering tomorrow. I say, well, thank you. Click. But if it comes from David's friend, who's a big financier and very high level guy, and David's known him for years, and they say, David, let me tell you about this deal. It looks pretty good to me. He'll read it. And that's what I tell a lot of people. If you want to venture capital to look at your deal, it has to come from a lawyer or someone that they really respect that's already vetted the deal.
Or if Dave is in, or one of the crypto guys that we just had on is on like in a crypto deal, then it has a tremendous ripple effect and bandwagoning effect. So Dave, can you talk towards that?
Yeah, so I think, so let me address a few things. So on the family office thing, I've in my banking career, and then since then, I've got a lot of exposure to different types of family offices. And I would say that, and this is a general comment, right? Because family offices are made up of different people and people are always different, right? But I'd say in general, they're kind of like two tiers of family office, right? There's kind of family office where they don't really have in-house staff and expertise to fully vet lots of different opportunities. They may focus and do direct deals on areas where the family made money. So maybe they were people who made money on Hot Pockets, or they made money in tech, and they know a lot about that category. So that's an area where they might do direct deals. But what I have found in general is that the family offices of a certain size are primarily doing secondary deals, investing in venture capital, and doing something very similar to what I'm doing, which is kind of barbell, right? They got fully diversified. 80% of their assets are in highly liquid, relatively lower risk, and then they allocate 20% to private equity. And then in that area, they primarily try to get into the top decile, top quartile funds. And if they're lucky enough, they get in there, or they have relationships with others that are maybe more fragmented and maybe are in certain areas that they're interested in, like fintech or crypto or areas like that. And then when the family office gets to a certain size and scale, or they are an aggregation of other families, which I've seen before, then they start to develop their own in-house staff, and they start to dabble in direct deals. And the most natural thing that they do is that they develop very strong relationships with venture capital and private equity firms that they have invested with for a long time as an LP. And they make sure that those firms know that, hey, by the way, if there are co-investment opportunities or situations where we can do direct deals with you guys, don't be shy about reaching out to us, particularly if you have a deal that you really like, but the check size required is bigger than what your fund mandate tells you. So that's generally what I have seen in kind of like the family office environment. But this notion that, and I'm not saying anybody here is saying this, but there is sometimes this notion, particularly among entrepreneurs, that family office is dumb money. It's kind of like, yeah, let's just get some family office money, right? And we'll get a higher valuation and they'll come in. And that's just not the case at all, right? Most family offices are going to still want a smart, branded lead investor. Most of the time it's a reputable VC or private equity firm. Or if they're going to do direct deals, they're probably going to hire people that used to work at these great firms, and they're going to do their own due diligence, and they're going to scrub the heck out of these deals. So I just want to make that comment that I've certainly heard that, particularly among younger entrepreneurs in Silicon Valley, that family offices are dumb money, and that's just not the case at all. Because if they're going to do direct deals, they likely have some kind of expertise, or they've built that expertise in that area.
Dave, let me just make one comment with regard to the family offices. Family offices stopped being dumb money in 2008 when the hedge funds pulled the gates out of the PE funds. That was it. It was over, and you're not going to find any more dumb family offices. So in terms of dumb money, but the other side of the coin is that I find that there's a lot of family offices that have done phenomenal in the crypto space, and the demands that family offices are now making of VC funds that they invest in are, they ask for part of the GP, right? They ask for special rights. I mean, they become very clever and smart about how to structure what they're doing. So they went from dumb money to super smart money pretty quick.
Yeah, absolutely. Yeah. And then, sorry, what was your second question?
So the first question was, family office investing. The second question was, what's the bandwagoning impact? Obviously, you've been very successful in what you do. If you ever need to syndicate a deal that you're maybe the majority investor in, et cetera. I don't know if you do syndicate deals, but people probably listen to you more than they would listen to somebody else who they don't really know.
Yeah. So first off, I don't do syndicated deals because again, I'm not in the business of generating my wealth by charging people fees on top of my investments, right? And there's a lot of people who do that, but that's just not something that I'm interested in. The way I get paid for my time is I buy equity and then I earn equity, directly from the company. And I found that to be a really winning formula for me. And it also helps me because I don't have to worry about, investors that I got to, give them an update on like what's going on with the company, and I just find that, again, if I'm not in that business, then why try to do that? So the bandwagon thing is interesting. So frankly, it goes all the way back to evolutionary biology and the caveman era, right? Which is we all benefit from social proof, and we use it as a way to figure out which mushrooms we should eat and which ones we shouldn't eat. And there are lots of people that are really good at picking mushrooms. And what we try to do is we try to leverage that. So I certainly see that. And I've seen that phenomenon, as a repeating cycle for the last 30, 40 years. Because the beauty about tech is that, there's always going to be something new, which means that there's always going to be massive asymmetry of information, because someone out there is pioneering a new category, which most investors don't know anything about. So if you want to generate massive outsized returns, and I mean massive, then you by virtue have to be early. And the way you do that is you either see something that other people don't, or you get lucky. And there are people, particularly in Silicon Valley, that are really good at both of those things. They're both really good at being lucky, but they're also really good at spotting like that next trend. So I think in areas like AI, crypto, blockchain, by extension, like these whole categories, right? There definitely are people that are doing party rounds and leveraging this bandwagon effect. And nothing is more powerful than a combination of social proof and FOMO, particularly as it relates to greed. And so I'm seeing this time and time again, particularly in the areas that I talked about, and the one that you mentioned, which is crypto and blockchain, because the category is evolving very, very quickly. It actually reminds me a lot of the early days of the internet, where people were still trying to figure out, like, is this thing going to be a real brand new platform, or is it just going to be a better place to sell shoes? We didn't know, right? And I think the same thing is happening in the crypto space, where there's just massive evolution, and the appetite for risk in the category, not only from trying new things, but also buying and investing in crypto assets is massive. I bet you, I saw some estimate, I don't know if it's true, but there are about 250,000 crypto investors in the world today. I bet you they're the same kind of people that would buy a one-way ticket to Mars. They're the same kind of people that would bungee jump, be the first to line up in a brand new bungee jump, when nobody's tested it before, right? These are truly pioneering investors who have massive appetite for risk, and for many of them, they're already playing with house money. The gains that they've had from Bitcoin, Ethereum, Dogecoin, whatever, are being bled into the NFT world, and I think you're just going to continue to see that because again, I think a lot of these people have massive appetite for risk, and so that's coming full circle. That's a category where I'm seeing the party round and the bandwagon effect very similarly to what I've seen in the Web 1 and Web 2.0 eras.
Well, Dave, just to be real quick on that, is that, obviously Pantera was with us when they had 2 million under management, now they've got 7 billion, right? But I mean, just in another area, Poseidon, which is a big cannabis fund, they also were tiny when they started with us, and now they're probably one of the biggest, VC funds in the space. So I think you're right. And again, there's lots of attributes around crypto that people talk about, and there's always the issue that the dollar strength only goes so far in the world, and only 10% of crypto holders are in the United States, right? And there's a lot more wallets out there than there are people. So but the real issue in the U.S. is that banks don't pay you any interest, whereas in the 70s you got 10 or 15% interest for deposits, and today you get nothing. And so the question, why not put money under your bed or in a crypto wallet instead, right? So there's a lot of thoughts on that, and I think that it's just simple, folksy reasoning that's going on behind this. And the other aspect of the crypto is that if you look at the demographics, the people in the United States who are buying crypto are young, and a lot of them are like first-generation Americans, and they typically tend to be ethnicities out of Asia or Latin America. So it's pretty interesting because a lot of them have had experience of hyperinflation, bad currencies, et cetera. So
yeah, I mean, just to add to, because I'm spending a lot of time in the space myself, is if you subscribe to Bitcoin as a digital gold asset, safe haven, and you look at the world's populations that are under regimes where their inherent currency, is somewhat manufactured, and let's put the U.S. dollar aside here for a minute. That's still a massive number of people, a lot of middle class and wealthy people around the world that might want to have some exposure to cryptocurrency as an alternative to their own home currency. And I look at that as kind of like the bottom of the layer cake of crypto assets, right? And then you go all the way up there at the top, and then you got non-fungible tokens and gorilla meme coins, right? But there's a whole spectrum there.
That's very interesting. Gene and Purvi, we've got we have to stop, but can you give about a minute to just closing statements and where you think the market is and what you're looking at?
Yeah, no, so just one correction. I don't source my capital from crowdfunding yet, and you've actually scared me away, so I'll probably never do that. When we spun out of JP Morgan, actually was the first time in my career we went off and raised $2.5 billion all from institutional investors. So our capital is all mostly institutional capital as well. But the closing statement I would say is, look, venture capitalists were always disrupting and funding the disrupting ideas, and in itself, in my view, the industry is getting disrupted. There's just a massive amount of new entrants. Family offices, actually, a point that David has made, are directly investing at a very rapid pace into companies, very smart people who can diligence quickly. And so I'm very excited that I was able to take something that we had incubated with overseas capital, deliver proven success, and then building an institutional firm to create more of a venture product to deliver that venture return, but at lower risk because you're investing in a high volume of companies across sectors and stages.
Gene, parting thoughts?
You know, for many years, I was a TV commercial director before, and I tried to finance a movie, and I got into securities. But I remember I did the Callaway golf spots for about 7 years, and I worked with Ely Callaway. And I remember him saying, if you want to be successful, come up with something that's new and pleasingly different. And that is really what is happening in crowdfunding. People are coming up with new things, all sorts of flying devices and all kinds of drones and things. I mean, it's wonderful if you stop and just go through these platforms, and you'll see that that entrepreneurs that never would have had a chance in a venture capitalist office are actually getting their things financed. Now, whether they'll be successful or not is an entirely different story, but at least they're getting an opportunity that they may not have had with their ideas and with their new things that they're trying. So I think it's a wonderful time. And I believe that if you're not inventing, you're dying. If you're not willing to be constantly innovating and changing and absorbing all of these new things that are out there now, these new financial instruments, then the train is leaving and you're going to be left at the station.